Welcome. In this video we are going to cover the topic of the average rate of return and investment appraisal ratio. The average rate of return is a quantitative tool that we use to assess the financial performance of an investment. It helps us to decide whether our organization should move forward with an investment or not. The formula for the calculation of the average rate of return is the following, where total returns is a measure of the total profits made by the investment over the course of its lifetime. Since profits are calculated by subtracting the costs to the revenue, then an approximation often used for profits are the net cash flows, as the net cash flow measures the inflows of cash minus the outflows of cash. And capital cost is the cost of the initial investment in the project. For example, if we were building a factory, that will be the cost of the construction. We're going to apply the following example. Suppose that a firm is undecided whether to purchase truck A or truck B. We are told of the cost and the years of usage. Then we get the information on the net cash flows of each truck for every year. With all this information, it appears an easy decision as truck A makes a lot more profits over its lifetime, 11 million euros, than truck B, 6 million euros. However, it is difficult to assess in this way the profitability of a project, as truck A also costs more. This is why we need to calculate a standardized form of assessment that takes into account the total profits, but also the cost and life of a project. If we apply the ARR formula to our two potential tracks, we get the following figures. Now we can see that despite the fact that track A generates in total more profits, its profitability is lower than that of track B. This matters because firms have a limited amount of capital to invest, so they want to place their money where it generates the highest return. Apart from letting us compare the return of investments quite easily, another advantage of using the average rate of return is the fact that it is calculated in the form of a percentage. This allows firms to set thresholds for their investments where they won't accept any project that does not reach a certain minimum percentage rate of profitability. In addition, it also makes it very easy to compare the return on the investment with the interest rates of the market. Say that the company went for track B. If the interest rates in the market are equal to 7% and the company has spare cash, it will be more profitable to simply let the cash remain in the bank and earn a 7% interest rather than a 6.67% return. More likely than this, however, firms need to borrow to invest. At this interest rate, it will not make any financial sense for the firm to borrow a loan at a 7% interest rate cost to earn a 6.67% return. But for any interest below that rate, it will be a good idea to borrow the money and generate profits. This is it. I hope you enjoyed the video. If you did, please like, subscribe, and leave a comment.